My name is Kelly Waugh and I am a certified mortgage coach with Fairway Mortgage, and I'm here to introduce to you the Homeownership Accelerator product. Now let's talk about what type of mortgages consumers are really asking for. When I ask a borrower what type of loan they want for their financing needs, they all want the same thing, a safe 30-year fixed rate mortgage. In fact, borrowers all tend to say the same thing, that interest rates are at all-time lows and they could be going up. But what I find funny about the 30-year fixed rate loan is the fact that it was invented in 1930s. In the last 80 years, the loan has not changed at all. So let me ask you a question. Do you know anything in America that was invented in 1930s that has not been improved upon in the last 80 years? Do you know the reason it is still used to this day? Profit. Profit for the banks. A 30-year fixed rate loan is the longest term offered by most banks and therefore the highest interest charged. In other words, longest term equals most amount of interest paid to the bank. The average interest charge for a 30-year fixed rate mortgage is 100% of the principal balance. Most people have no idea. In fact, if you get a really good rate on a 30-year fixed rate conforming loan at 4.5%, your interest charge over 30 years is 82% of the original principal balance. That's just crazy. But imagine if you got a really good jumbo rate at 5.375. In that case, your interest charge is 102% of the principal balance. So in this example, you see a $1 million loan at 5.375 with a payment of $55.99. Over the course of 30 years of 360 months, you'll pay $2,015,895. If your total home loan that you took out was $1 million, then it equals a net interest cost of $1,015,895. It's just crazy. Over $1 million in interest. Does anyone really want to pay that much for interest? Do you want to know what is even crazier than the total interest charge on a 30-year fixed rate mortgage? Well, first let's be clear. Virtually everyone in a 30-year fixed rate loan refinances well before the 30-year term. In fact, the average borrower refinances or sells their property within 3 to 5 years. The banks know this and even plan for it. So during the first 5 years of a 30-year fixed rate mortgage, the borrower will pay up to 25% of the total interest charge. I repeat, in the first 5 years that the borrower pays on the amortization schedule, they will pay 25% of the total interest charge. So for example, if you have a home loan of $1 million at 5.375, your payment is $55.99 a month. Total payments over 5 years or 60 months is $335,982. Principal reduction out of that over the 5 years is only $76,937, but the interest charge equals $259,042. So to recap, in 5 years the borrower has paid $77,000 in principal reduction and almost $260,000 in interest. So let's say someone stays in their 30-year fixed rate loan. Do you know when the borrower's payments will equal 50% interest and 50% principal? Not until 17.2 years into the loan. That's right, you would have to pay your monthly payment for over 17 years before your payment is going towards principal and interest equally. Every payment prior goes more towards interest than principal. The bigger problem is that generally no one stays in a loan for 17 years. In fact, it's estimated that 80% of all Americans who can refinance have in the past 2 years. Do you know anybody that has been in a loan for 17 years? I don't. So now let me ask you, how do other countries lend money for real estate financing? Further, what are other countries' banking models like compared to the United States? So first, let's take a look at the U.S. banking model. Let's assume you have a mortgage with an interest rate between 4.5% to 5%, or 5.5% I should say. You also have a checking account with the bank and make less than 1%, and a savings and or CD rate account that pays between 1% and 2%. So let's look at a typical loan. If a borrower pays $500,000 or has a $500,000 mortgage with an interest rate of 4%, their monthly interest payment will be $1,667. Now that's just interest. Let's also assume that the borrower also has $100,000 in a checking or savings account or CD that pays them 1%. In other words, the bank pays the customer about $83 per month. Therefore, if you take what the borrower makes, the $83, from the bank and subtract it from their monthly mortgage cost of $1,667, the borrower in effect is paying the bank a net interest cost of $1,583. Now let's take a look at Great Britain's offset account. Assume the borrower still has a mortgage debt of 4.5 to 5.5%, and the borrower has liquid assets with the bank in the form of a CD or savings account. In the offset model, the bank allows the dormant assets of the borrower to offset the principal balance of the mortgage. Therefore, it's reducing the principal the borrower owes. In this example, if the borrower has $100,000 in the bank, the net interest cost is based on $400,000 instead of $500 at the 4%, or a monthly payment of $1,333. So instead of paying $1,583, it's a savings of basically $250 a month. So which model is better for you? The U.S. banking model with a net interest cost of $1,583, or the British model of $1,333? So is your money working for you, or is it working for the bank? Let's look at my last loan. As I do with all borrowers, I asked him what type of loan he wanted, and the borrower said I wanted a 30-year fixed loan. I said, you know, with a loan amount of $500,000 at 5.5%, that will give you a payment of $2,838, okay, per month. I asked him if he liked the payment, and he said no, but he insisted on a 30-year fixed loan. I told him I wanted to present him with another option. For example, let's take a look at the Homeownership Accelerator program. Now granted, this is a 1-month ARM. That means it can adjust every month. But you could save a lot of money. And the borrower said, Kelly, I'm not interested in an ARM, but I'll let you go ahead. So first, I told him that the interest charge is only 3.610 on a $500,000 loan and is only $1,504 per month. In fact, the HOA or Homeownership Accelerator rate would need to almost double, as you can see down here, before he would have to make a payment greater than $2,838 per month. The borrower then said that the interest rate could double tomorrow and could continue to go up, and he would end up making a higher payment in no time. I told the borrower that I really don't see that happening anytime soon, but fear is fear. So I asked him the question, how much money will you have in liquid reserves after closing? The borrower informed me that he would have about $150,000 in between checking, savings, and a few CDs. I asked him, how much are you making on those assets? And the borrower said around 1%. So if you're making 1% off your liquid assets of $150,000, you're making $125 a month. However, if you're able to float the $150,000 against your mortgage, but still maintaining full access to it, you get a debit card, you get credit card, checks, online banking, everything, you would be able to save $451 per month based off of your mortgage payment. So I just lowered your minimum monthly payment down to $1,052.92. That's a savings of $1785 per month. The borrower replied, yes, but interest rates can still go up, and I don't think I'd be able to sleep if I knew I had an adjustable rate mortgage. So to kind of settle his fears a little bit further, I told the borrower that his rate would need to go to 9.73 before he would make a payment greater than $2,838. More importantly, I told him that his life cap, the life of the loan, the max that the rate could ever adjust high to, is 9.5. So therefore, he would never make a payment greater than the $2,838 per month unless he didn't pay down the loan at all over the next 10 years. Because basically the line limit does start to reduce after 10 years. So the borrower said, so basically there's no risk as long as I'm floating my assets against my mortgage? And I replied, yes. So he basically said, what an awesome product. You know, it's a great loan. Where do I sign up? Just don't let this opportunity pass you by. This isn't a program that has been around for very long. It's a very unique program for the right borrower. Thank you for your time. Again, my name is Kelly Waugh of Fairway Mortgage, and you can reach me at 704-200-2323 or on my email at kellyb@fairwaync.com. I'll look forward to working with you.